Welcome, everybody, to the Quarter 3 Economic Update brought to you by IntentGen Financial Partners. My name is Jacob Schatz. I'm a partner and wealth advisor at the firm, and we appreciate that you're joining us. This is a series of 4 videos, as you know, that we've done throughout the year. 2 of them are more outlook-based, and then the other 2 are more tactically focused on what's happened, why it's happened, and how that influences the portfolio. So today is going to be the latter portion, and with me today to go through some of those details is our in-house investment manager, also CFA, Patrick Morris.
Hello.
And very good. So let's go ahead and jump into really just looking back through end of the quarter. And I think some of those themes would have continued through October, but really across the boards, markets taking a step back. So on the left-hand side in the darker blue is our fixed income sleeve. In the middle portion in the gray is the equities. And then on the far right in lighter blue is real assets. The circles indicate the quarter to date numbers, and then the bars indicate the year to date side. So what we saw in fixed income was volatility continued, and most segments posted negative returns as interest rates rose, with the Fed Reserve and central bank continuing to tackle inflation. Most of the shorter, or I would say mid to long duration fixed income fell backwards. High yield, which tends to be less interest rate sensitive, that actually posted the best return in the segment. Again, longer duration assets saw larger declines in the quarter as those longer dated rates experienced a sharper jump this quarter. Additionally, equities were broadly lower in the period as higher interest rates led to a repricing of valuations. We did see US on a relative basis, large cap outperform small cap. Developed non-US struggled in the quarter. The Eurozone continues to have weak economic activity, and central banks remain in a tightening stance. Emerging markets did, compared to developed non-US, outperform the quarter, but we're still negative on an absolute basis. We've seen some positive momentum in the Indian economy, provided a tailwind for the emerging region. And on the right-hand side, moving into the real assets, REITs took a step back during the period. Self-storage, diversified, and residential were among the worst performing subsectors of the asset class. Commodities were a standout in the third quarter. Strong results stemmed from a jump in the oil prices. And looking back then on the next slide, we started to see that global divergence really persisted. So looking at a number of the countries, both developed and emerging, mostly negative across the board, but did see some diverging performance. Europe, especially Germany and France, struggles as their economies struggled. Germany now has had 2 quarters of negative GDP. India has been a positive with a 5% GDP growth and introduction of a spending bill per package on infrastructure. And then China, we see continuing to struggle with COVID reopening and real estate issues. But despite a tough quarter, equity markets have had a positive year through 3 quarters.
All right. Thanks, Jacob. Yeah, going to take a quick look here at some of the valuations, starting with the U.S. And the top part there is the S&P 500. So this is the large cap, and it is basically at about 18 times forward PE. That is above the 20-year average, which is 16. So it is fully valued, a little bit above that, but not excessive. As you can see, pre-COVID, we had numbers that were higher than that they are now. If we compare that to the Russell 2000, which is on the bottom there, that is obviously the small cap, we see that its forward PE is 19 times. The 20-year average is about 21, and the Russell 2000 is an interesting benchmark because about 30% of the companies don't make any money. So if you took those out, forward PE would look even better. The multiple would look better. So when we're looking at multiples, the higher, the more unattractive. So if we look at this in a box kind of spectrum where we're going to say small cap, mid cap, large cap, growth, core, value. In the upper left box, you would have the growth, which would be large cap growth, which is at right now about a 30% premium to the S&P. And that is basically, you're getting it from the names that we've talked about before in the past: Apple, NVIDIA, Amazon, Meta, used to be known as Facebook. And in the lower left, or excuse me, the lower right-hand corner, you would see the small cap value, and that is at 16% discount to its normal PE. Does this mean in 2024 that we're going to see small cap value outperform large cap growth? We not especially. We don't know. That's why we build kind of portfolios with diversification. But in the long term average of valuation is a great guide to stock performance. Now, if we look at valuations outside the United States, the IFA, which is the developed market, is about 14 times, and that's below its 20-year average. Now, you're saying 14 times and the US is at 18 times. They're kind of apples and oranges. The US is very much technology-based, its market is, so it always demands a higher multiple. But nonetheless, US was slightly overvalued and IFA is slightly undervalued. Now, the emerging markets actually comes right in line, 14 times its PE. And, you know, besides having China, which is the largest part of the market and kind of underperforming, like Jacob alluded to, India's been having a very good year, and so is Brazil. So again, diversification, we're not just buying one market, we're buying all the markets. So that kind of leads us into the long end of the curve. So the third quarter, we saw a lot of volatility on the interest rate front. You see, we started the quarter at 3.81. We ended the quarter at 4.59. That's about 0.8% or 80 basis points. That's a rather large move. And why is this? Why is the move? Well, the lion's share of it is this: we're going to be higher for longer. The Fed kind of is pushing things out. We've seen the interest rates that we thought would change at the beginning of the year or towards the end of the year haven't been changed. They're pushing things out further. So, but that's not the only reason. There's other reasons behind it. One, there's more foreign competition. Before, bonds in Germany had a negative yield, so people were coming to the United States for even a small yield. Now people have choices. Secondly, the U.S. is issuing more debt, so there's more dollars going out there, and if people there's less demand, more supply, people are demanding a higher rate. And lastly, China just hasn't been buying as many of our securities as they had in the past. So kind of weakened demand and a lot of supply is leading to a higher interest rates, which is pushing down bond prices. But the credit quality of the bond portfolios is in good shape, and there hasn't been a lot of volatility, as you can see. The credit quality or the credit spread, so that's the spread you basically are getting for taking risk above and beyond a U.S. Treasury bill, note, or bond. So the U.S. corporate investment grade right now is 121 basis points above its benchmark. Its 10-year average is 124, so it's right in line. And the same thing with high yield. So 394, and the 10-year average is 428. Normally in a recession, as we spoke about before, you could see the high yield at 800 basis points or 7 or 8% above where it would be above the Treasury. So I think a lot of the corporate players in the market, did a lot of their refinancing when rates were low, and they're reaping the benefits now. So maybe not so much on the consumer side, though. So here we're checking in, and people talk about consumer spending being strong, and the consumer continuing to spend it. And it's true, because consumers are the largest part of GDP, or we drive GDP, right? Getting on a plane, going out to eat, buying stuff, all this stuff kind of drives the economy. And this first slide is from the Federal Reserve, and it shows kind of how the spending, consumer savings was going prior to the pandemic. And it was kind of nice and steady Eddie. And then you see it blip up 3 times, and that's stimulus that the government put in place to kind of get us out of a recession or stop the recession. And then things have kind of went down below that trend line, and it looks like they're kind of trending upwards. So, but that differs from this chart, the estimated US household excess savings. And you can see it's the same company, and they're doing three different graphs or three different lines on the graph, and they all kind of disagree, but the trend is the same, right? The trend is down. So the timing of when that is going to go negative is different, but the trend is the same. So basically, what's going to happen if this continues on and it goes down? Well, then consumers are going to have to tighten their belts, and that could, now we don't say lead into a recession, but could lead to, some economic weakness. And do we know when? No, but as we said before, and we tried to hammer home the point, we're not trying to predict a recession. We're trying to prepare for one. So that's the portfolios we build, taking all these inputs to kind of come up with a plan that when we build a resilient portfolio for you guys. So while the Fed does focus on consumer spending, they spend most of their time worried about inflation. So and they've done a pretty good job on it. Last summer, it was at 9%. No matter how you kind of look at it, if you look at CPI or the core CPI or the PCE, which is what the Fed likes to look at, it's basically gone from 9 to somewhere between 3.5% and 4%. So they're continuing to fight this, and it might take a little longer, but they're going to continue on. But the market itself, the US break even, which is kind of like the 5-year and 10-year smoothing of it, is pretty much, has settled down. I mean, last year in the middle, it was looked like 3.5 long-term inflation or 3% long-term inflation. And now that is back down to 2.4 and 2.2. So, a lot of these things the market is taking care of. Now, bear with me on this slide because it's a little cumbersome, but basically this is the futures market for the federal funds rate at 4 different times. So it's looking at what the federal funds rate would be in the summer of 2024. And we're looking at it from at the beginning of 2022 and then every 3 months after. So the beginning of 2022, everybody thought we're going into a recession and the Fed's going to have to cut rates. And eventually, by the middle of 2024, we were going to be on the downward path. So it looks like basically the rates were going to be somewhere, the Fed funds was going to be somewhere between 375 and 400. And it looked like that on 331 as well. But as you can tell now, it has shifted down. So now the market is basically saying that Fed funds rate will be similar. I think we're at, I know we're at 525, 550. And this is saying it's going to be somewhere between 5 and 525. So very little movement, and there's an equal probability that it'll be a little bit less and a little bit more. So this is something that we're using to kind of build into portfolios that rates are going to be higher for longer. And I'll turn it over to Jacob now for some fixed income performance.
Yeah, certainly some of the more boring topics to dive into fixed income, but what we were looking at is right now just looking across the board, a lot of parity, and that has really to do with where rates have been, but yields across the board, T-bills, intermediate credit, aggregate credit, those are all anywhere from 5.4 down to 5.2. As well as duration is there in that range too. High yield, obviously a little bit higher as we had talked about the sensitivity to interest rates. So there's not a big spread or gap at all from a T-bill compared to the Bloomberg US Ag. But I think as Pat alluded to, a lot of eyes and watching towards rates. And I think this is a good call out because we do get this question right now as you are getting compensated for holding cash finally. You're holding money in perhaps high yield savings that is getting a good yield without risk. And then also perhaps you're taking advantage, we've been utilizing enhanced reserve accounts for clients, which CDs, treasury bills, money markets, so using a variety of those laddered out solutions to generate yield too. So a question was just posed, periodically from clients is why not just hold cash instead of earning fixed income? And we touched on this at the last economic update, but really felt like the worst was behind us in the bond side, where we went through a historically poor period for fixed income with inflation and interest rates. And there is a brighter outlook perhaps to fixed income in the future. As we look down here at the bottom, it looking the date of the last Fed rate hike and the pause, so the months to the next cut, and then the forward-looking 3-year return of the Bloomberg Ag compared to cash. And we do start to see a quite a bit of difference develop over that period from in 2018, we saw 5% versus 0.9. 2006 was at 6.6 versus 3.1, and you can follow down, but on average about 7.8 versus 3.6. So we still think there's thoughtful reasons and to have fixed income as part of your portfolio to complement the equities as well as the cash position.
So we took that and went a little step further here. And so this is the Bloomberg aggregate yield to worst, or the yield on the Bloomberg aggregate is the light blue. And the dark blue is the S&P 500 earnings yield. And the earnings yield is just the inverse of the PE. So it's the earnings over the price. So kind of the yield on what the S&P earnings are, not its dividend yield, but the earnings yield. So as you can see, they haven't touched since pretty much 2022. That's because bond rates were so paltry. Corporate bonds were getting a 1.5% yield. You weren't getting any money. And now there's an alternative. And part of our, the beginning of the year 2023 was, Tina, there is no goodbye, Tina, there is no alternative. And now there is an alternative. So this is going to be something that we're going to definitely take into account when we're building portfolios, especially, maybe on the conservative or moderate side. You're looking at bonds that are getting 5.5% yield. If nothing happens in the market, they'll get 5.5% yield. So it's just something that we're going to take into consideration when building bond portfolios or portfolios in general, because again, this is a landscape that's changed since the last couple of years.
Thanks, Pat. And again, thanks everybody for your attention today. This was just a thing that we had put out here is, what would you have predicted for stocks for the year based off of these headlines? And you could overlay this for any previous year of having different headlines. But what we see is there's this continual wall of worry because there's always going to be something that's going to be headline driven that's occurring. Bank failures, interest rates rising, U.S. deficit, U.S.-China tensions, U.S. Treasury debt downgrade, S&P 500 earnings, which we've actually seen. I think it was like 70% have actually posted above projected return or earnings. Government shutdown, China slowdown. Most recently, the Middle East conflict, which we've been keeping a very close eye on, and on a humanitarian level, it's awful to see what's going on. At this point, we have not seen the market or economic impact influence things, but certainly a lot of cause for concern. Certainly, if Iran were to become more pulled into it, that would be more of a oil producer and exporter that could influence things. So we're keeping a close eye on things, but every month, every quarter, there's going to continue to have things that are going to cause worry and concern. We would just say, let's take a step back and let's focus on time and purpose and alignment of your assets with the goals that you have and when we need to use it. And that's going to help better influence the decisions that we make on your investment thesis on your portfolio. And so we're in the process of getting ready for our year-end review. We continue to review things on a monthly basis. We did recently make some adjustments. Pat, maybe you want to just share like a couple comments on our enhanced income portfolios, which some clients have, just some of the recent adjustment that we made back in October on that.
Sure. Yeah. In our enhanced income portfolio or portfolios, we went through and we changed our large cap allocation from holding, which was HDV, which is a high dividend yielding fund, and added DGRW, which is a dividend grower. So basically, dividends kind of fall into two camps. One is dividend yield, and then one is buying stocks that have dividends, and those dividends are going to grow, so future growers. So we thought it would be, we looked through and we decided that, served the portfolio better. There was better, we're still getting a 2 times the S&P 500 yield. We got better sector diversification and, the possibility for further growth.
Great. And we're continuing to do that research and overview across all of our portfolios and all of your accounts. We'll be wrapping up here our year-end due diligence, and then right around the first of the year, we'll be recasting then our 10-year outlook, our market outlook. So we'll be delivering updated market themes, what's going to perhaps influence the portfolio, as well as our updated strategic targets. So not just where we want to be at for the next month, but the longer term period. And then a full fund review. So like we always do, we're looking at expenses, we're looking at fund manager performance, ETF versus mutual fund, and peer performance, and if managers are adding value, as well as sector and underlying stock selection. So we'll have that information out to you at the end of the year here. But in the meantime, if anything comes up that you have questions on, please don't hesitate to reach out to myself or Pat. That's Patrick at IntentGen.com, as well as my email and information is Jacob at IntentGen.com. Again, we greatly appreciate your attention today and your time, and look forward to talking with you again soon.
Thanks, everyone.